Welcome back to Boni's Life, where we decode the future of money, technology, and everything that matters to your financial success. I'm Boni, and today we're diving deep into the most explosive sector of 2025. Artificial intelligence, startups that are reshaping our world and creating unprecedented wealth opportunities. Now, before you roll your eyes and think another AI video, let me tell you something that might surprise you. While everyone was arguing about whether ChatGPT would steal their jobs, AI startups quietly raised over $104 billion in just the first half of 2025. That's not a typo. 104 billion with a B. To put that in perspective, that's more than the GDP of most countries, and we're only halfway through the year. But here's the kicker. And this is where it gets really interesting for investors like us. Most of this money is going into companies you've probably never heard of. While everyone's talking about OpenAI and Google, there's a whole ecosystem of AI startups that are solving real problems, generating real revenue, and creating real wealth for early investors and employees. Today, I'm going to break down the Forbes AI 50 list for 2025, share insights from Federal Reserve economists who just published a fascinating analysis on AI's economic impact, and reveal which startups are getting the smart money from Silicon Valley's top venture capitalists. We'll also explore what leading economists, traders, and industry experts are saying about this AI boom, and whether it's sustainable or just another tech bubble waiting to burst. The numbers are staggering. According to the latest data from PitchBook, almost two-thirds of all US venture funding is now going to AI companies. That's up from 49% last year. We're witnessing the largest capital allocation shift in venture capital history, and it's all flowing into artificial intelligence. But here's what makes this different from previous tech booms and why Federal Reserve economists are paying close attention. These aren't just companies building cool demos. Many of these startups are already generating significant revenue and solving real business problems. Some are even profitable, which, let's be honest, was pretty rare during the dot-com boom. So buckle up, because we're about to explore the companies that could define the next decade of technology and wealth creation. And if you're wondering whether you should be investing in AI stocks, working for an AI company, or maybe even starting your own AI venture, this episode will give you the insights you need to make informed decisions. Let's start with the big picture, then dive into the specific companies that are making waves in 2025. Before we dive into specific companies, let's understand what's really happening in the AI market right now. And trust me, the picture is more complex than the headlines suggest. I recently analyzed a fascinating report from Federal Reserve economists. Yes, the same people who decide interest rates are now studying AI startups. Their conclusion? Quote, "Our modal forecast is for a noteworthy contribution of generative AI to the level of labor productivity." But here's the catch. They're comparing AI to two very different historical innovations: the light bulb and the electric dynamo. The light bulb was revolutionary, but it was essentially a one-time productivity boost. Once everyone had electric lighting, that was it. No more productivity gains from that innovation. The electric dynamo, on the other hand, kept generating new innovations and business models for decades. The question Federal Reserve economists are asking is, which one is AI? Now, here's where it gets interesting for investors. The Fed economists found that companies using GitHub Copilot, that's Microsoft's AI coding assistant, are completing programming tasks 56% faster. Call center operators using conversational AI saw a 14% productivity boost. These aren't theoretical gains. These are real, measurable improvements happening right now. But, and this is a big but, Most of these gains are concentrated in large corporations and tech-savvy industries. As PitchBook's senior research analyst Dmitry Zabelin told CNBC, the main hurdle is diffusion. In other words, AI is working great for Google and Microsoft, but your local restaurant or accounting firm, they're still figuring out how to use it. This creates a massive opportunity for the startups we're about to discuss, the companies that can bridge this gap, that can take cutting-edge AI and make it accessible to regular businesses. Those are the ones that could see explosive growth. Now let's talk about the money. Mackenzie Sigalos from CNBC reported that AI startups raised $104.3 billion in the first half of 2025 alone. But here's the plot twist that most people are missing. While money is pouring in, it's not flowing out. There were only 281 venture capital-backed exits totaling $36 billion in the same period. What does this mean? It means we're in the investment phase, not the cash-out phase. For investors, this could be either a massive opportunity or a warning sign, depending on how you look at it. The optimistic view is that we're still early and the big exits are coming. The pessimistic view is that we're inflating another tech bubble. I tend to lean optimistic, and here's why. Unlike the dot-com boom, many of these AI companies are already generating real revenue. Anysphere, which makes the AI coding tool Cursor, has at least $100 million in annualized revenue and is valued at $2.5 billion. That's not a fantasy valuation. That's a company with real customers paying real money for a product that demonstrably makes them more productive. All right, let's get to the meat of today's episode, the specific companies that are reshaping the AI landscape. I've analyzed the Forbes AI 50 list, cross-referenced it with funding data, and identified the startups that I believe have the highest potential for explosive growth. These aren't just my opinions. They're backed by serious money from serious investors. Let's start with Anysphere, better known by their product name, Cursor. If you're not a programmer, you might think this is just another coding tool. You'd be wrong. This is potentially the future of software development, and it's already generating over $100 million in annual revenue. Here's what makes Cursor special. It's not just auto-completing your code. It's understanding what you're trying to build and helping you build it faster. Imagine having a programming partner who never gets tired, never makes syntax errors, and has read every programming tutorial ever written. That's essentially what Cursor provides. The company raised $176 million and is valued at $2.5 billion, which might sound expensive until you realize they're growing at a rate that would make most SaaS companies jealous. Founded in 2022 by 3 MIT graduates, they've managed to do something that Microsoft, Google, and Amazon are all trying to do: make AI coding assistants that developers actually want to use. But here's the bigger picture. If AI can make programmers 56% more productive, and that's the conservative estimate from the Federal Reserve study, then every software company in the world needs tools like Cursor. We're talking about a total addressable market that includes virtually every technology company on Earth. Now, this one is fascinating from an industry insider perspective. Thinking Machine Labs was founded by Mira Murati, the former CTO of OpenAI. When someone who helped build ChatGPT leaves to start their own company, you pay attention. The company is reportedly raising $1 billion at a valuation of around $9 billion, which is remarkable for a company founded in 2024. But here's what makes this interesting. Murati isn't just building another chatbot. According to reports, Thinking Machine Labs is developing broadly capable AI systems, which is Silicon Valley speak for artificial general intelligence. Now, I'm not saying they're going to achieve AGI next year, But when someone with Murati's track record and connections is working on this problem, and when investors are willing to put $1 billion behind her vision, it suggests we might be closer to major AI breakthroughs than most people realize. From an investment perspective, this represents a bet on the next generation of AI capabilities. If they succeed, early employees and investors could see returns that make the OpenAI success story look modest. Speaking of AI legends starting new companies, we have World Labs founded by Fei-Fei Li, who's known as the godmother of AI. Li was instrumental in developing ImageNet, which basically kickstarted the modern AI revolution. When she starts a new company, the entire AI community pays attention. World Labs has raised $291.5 million and is focused on developing AI models that can understand physical spaces. This might sound abstract, but think about the applications: autonomous vehicles that better understand their environment, robots that can navigate complex spaces, augmented reality systems that seamlessly blend digital and physical worlds. Li has a track record of being about 5 years ahead of everyone else in AI. ImageNet was released in 2009, but it wasn't until around 2014 to 2015 that the broader tech industry realized how important it was. If that pattern holds, World Labs could be working on technology that won't seem obvious to the rest of us until 2029 or 2030. Now let's talk about Scale AI, which just received a massive $14.3 billion investment from Meta. But here's the twist. This wasn't really an investment. It was more like an acquisition disguised as an investment, with Meta essentially hiring away CEO Alexander Wang and key team members. Scale AI specializes in data labeling and AI infrastructure. Basically, they help other companies prepare their data for AI training. This might not sound sexy, but it's absolutely critical. As any data scientist will tell you, the quality of your AI model depends entirely on the quality of your training data. What makes Scale AI's story interesting is that it demonstrates how valuable AI infrastructure companies have become. When Meta is willing to pay $14.3 billion for a data labeling company, it tells you something about how seriously big tech companies are taking AI development. For investors, this suggests that the picks and shovels approach to AI investing might be just as profitable as betting on the AI applications themselves. Companies that provide the infrastructure for AI development could see sustained demand regardless of which specific AI applications succeed or fail. Perplexity AI has raised $900 million and is positioning itself as an AI-powered search engine that could challenge Google's dominance. Now, I know what you're thinking. Lots of companies have tried to challenge Google and they've all failed, but Perplexity might be different. Instead of giving you a list of links like Google, Perplexity gives you direct answers with citations. It's like having a research assistant that can instantly synthesize information from multiple sources. For complex questions, this is often much more useful than traditional search. The company has been growing rapidly, and more importantly, it's changing user behavior. People who start using Perplexity often find themselves going back to Google less frequently. That's the kind of user engagement that could eventually threaten Google's search monopoly. From a market perspective, search is a massive business. Google's search revenue alone is over $100 billion annually. If Perplexity can capture even a small percentage of that market, it would justify its current valuation many times over. 11 Labs has raised $281 million and is revolutionizing voice generation technology. This London-based company can clone voices with just a few minutes of audio, and the results are so realistic they're both impressive and slightly terrifying. But here's why this matters for investors. Voice is becoming the next major interface for AI. As we move toward a world where we talk to our computers more than we type, Companies that can generate natural-sounding speech will be incredibly valuable. 11 Labs is already being used by content creators, audiobook publishers, and even Hollywood studios. The company has faced some legal challenges around voice cloning, which actually validates how good their technology is. When voice actors are suing you because your AI is too realistic, that's a sign you've built something powerful. Figure A. AI has raised $750 million to build humanoid robots. And unlike most robotics companies, they're actually making progress. Their robots can perform complex tasks like making coffee, folding laundry, and even having conversations while they work. What makes Figure AI different is their focus on practical applications. Instead of building robots that can do backflips, looking at you, Boston Dynamics, they're building robots that can work in warehouses, factories, and eventually homes. The total addressable market for practical robotics is enormous, potentially reaching into the trillions of dollars. The company has partnerships with major manufacturers and is already testing their robots in real-world environments. If they can achieve even modest success in automating manual labor, the economic impact could be transformative. Runway has raised $545 million and is building AI tools for video creation and editing. Their technology can generate realistic videos from text descriptions, edit existing footage in ways that would have required expensive visual effects teams, and even create entirely new scenes. The creative industries are worth hundreds of billions of dollars globally, and they're all being disrupted by AI. Runway is positioning itself at the center of this transformation. Major studios are already using their tools, and independent creators are using Runway to produce content that would have been impossible just a few years ago. What's particularly interesting about Runway is how they're handling the copyright and ethical issues around AI-generated content. They're working with creators and studios to develop fair compensation models, which could make them the preferred platform as the industry figures out how to adapt to AI. Now let's step back and look at what leading economists, regulators, and industry experts are saying about this AI boom. Because while the startup stories are exciting, the bigger question is whether this growth is sustainable. Federal Reserve economists published a comprehensive analysis comparing AI to historical technological revolutions. The key insight is that AI might be both a general-purpose technology like electricity and an invention of methods of invention like the microscope. What does this mean in practical terms? It means AI could drive productivity growth for decades, not just years, but, and this is crucial, only if companies can successfully integrate AI into their operations. The Fed economists found that the main hurdle is diffusion, getting AI from Silicon Valley labs into mainstream businesses. This creates a massive opportunity for the startups we've discussed. The companies that can solve the diffusion problem, that can make AI accessible to regular businesses, could see explosive growth as the technology spreads throughout the economy. Here's something most AI investors are ignoring: regulatory risk. According to Pew Research, 62% of the public and 53% of AI experts have little confidence in the government's ability to regulate AI effectively. But that doesn't mean regulation isn't coming. The European Union is already implementing comprehensive AI regulations, and the US is likely to follow. For investors, this creates both risks and opportunities. Companies that proactively address safety and ethical concerns could gain competitive advantages, while those that ignore regulatory trends could face significant challenges. The smart money is betting on companies that are building responsible AI from the ground up, rather than trying to add safety features as an afterthought. From a trading perspective, AI stocks present a classic growth versus value dilemma. Many AI companies are trading at valuations that assume perfect execution and massive market expansion. But the potential returns are so large that even a small probability of success could justify current prices. Professional traders I've spoken with are taking a portfolio approach, making smaller bets on multiple AI companies rather than going all in on any single stock. The logic is that if even one or two of these companies achieve their potential, the returns could more than compensate for the failures. One trend that's often overlooked is the massive infrastructure build-out required to support AI development. Companies like Crusoe Energy, Lambda, and Together AI are building the computing infrastructure that powers AI training and deployment. This year, companies will spend $400 billion on AI infrastructure. That's according to the economists' latest analysis. This creates opportunities for investors who want exposure to AI growth without betting on specific applications. The infrastructure companies often have more predictable revenue models and face less competition than application layer startups. They're essentially selling picks and shovels during a gold rush, which historically has been a profitable strategy. So, what does all this mean for you? Whether you're an investor, an entrepreneur, or someone just trying to understand where the world is heading, here are the key takeaways from our deep dive into the AI startup ecosystem. First, if you're thinking about investing in AI, understand that we're still in the early stages. The Federal Reserve economists are right. This technology has the potential to drive productivity growth for decades. But the path won't be smooth, and not every company will succeed. The smart approach is diversification. Instead of betting everything on the next OpenAI, consider a portfolio approach that includes infrastructure companies, application developers, and picks and shovels businesses. Companies like Scale AI, Crusoe Energy, and the other infrastructure players might offer more stable returns than the headline-grabbing AI model developers. Also, pay attention to companies that are already generating real revenue. Anysphere with its $100 million in annual revenue, or Perplexity with its growing user base. These companies have proven that people will pay for AI solutions. That's a much safer bet than companies that are still figuring out their business model. If you're thinking about your career, the message is clear. AI skills are becoming essential across virtually every industry. But here's the nuance that most people miss. You don't need to become an AI researcher to benefit from this trend. The biggest opportunities are often at the intersection of AI and domain expertise. If you understand healthcare and can work with AI tools, you're more valuable than someone who only knows AI. If you understand finance and can leverage AI for analysis, you're in high demand. The Federal Reserve study found that AI adoption is still concentrated in large corporations and tech companies. This means there's a massive opportunity for professionals who can help smaller businesses and traditional industries adopt AI technologies. If you're thinking about starting an AI company, focus on solving real problems for real customers. The market is getting saturated with AI chatbots and image generators. The opportunities are in applying AI to specific industries and use cases. Look at the companies we discussed today: Cursor for programmers, 11 Labs for voice applications, Figure AI for robotics. They're not trying to build general AI. They're using AI to solve specific problems better than anyone else. Also consider the regulatory environment. Companies that build responsible AI from the beginning will have advantages as regulations inevitably tighten. This isn't just about avoiding problems. It's about building trust with customers and partners. Now, I wouldn't be doing my job if I didn't mention the risks. The AI boom has some characteristics of previous tech bubbles. massive valuations, intense hype, and a lot of money chasing relatively few opportunities. The exit data is concerning. While $104 billion flowed into AI startups in the first half of 2025, only $36 billion came out through exits. That's not sustainable long term. At some point, investors will want to see returns, and not every company will be able to deliver. There's also the possibility that AI development hits unexpected technical barriers. Despite all the progress, we are still far from artificial general intelligence, and some of the most ambitious companies are betting on breakthroughs that might not happen on their expected timelines. Finally, there's regulatory risk. Governments around the world are struggling to figure out how to regulate AI, and the rules they eventually implement could significantly impact which companies succeed and which fail. So what should we watch for in the remainder of 2025 and into 2026? Here are the key indicators I'll be monitoring. First, enterprise adoption rates. The Federal Reserve economists identified diffusion as the key challenge. If we start seeing rapid AI adoption in traditional industries, manufacturing, healthcare, education, that would be a strong signal that the productivity gains are real and sustainable. Second, the exit market. We need to see successful IPOs and acquisitions to validate current valuations. CoreWeave's successful public offering was a good start, but we need more data points. Third, regulatory developments. How governments choose to regulate AI will significantly impact which business models succeed. Companies that can navigate the regulatory environment effectively will have major advantages. The AI revolution is real, and it's happening faster than most people realize. The companies we discussed today, from Anysphere to World Labs to Figure AI, represent different bets on how this technology will reshape our economy and society. Some of these companies will fail, some will be acquired, and some might become the next generation of tech giants. The key is understanding that we're witnessing a fundamental shift in how work gets done, how businesses operate, and how value gets created. For those of us watching from the sidelines, the opportunity is to position ourselves, whether as investors, professionals, or entrepreneurs, to benefit from this transformation. The companies that succeed will be those that can take cutting-edge AI technology and make it useful for real people solving real problems. That's the lesson from every previous technological revolution, and it's the lesson that will determine which of today's AI startups become tomorrow's success stories. Thanks for joining me on this deep dive into the AI startup ecosystem. If you found this analysis valuable, make sure to subscribe and hit the notification bell. We'll be tracking these companies and trends closely as they develop. And let me know in the comments which AI startup you think has the best chance of success. I read every comment and often use your insights for future episodes. Until next time, this is Boni, reminding you to stay curious, stay informed, and stay ahead of the curve. The future is being built right now, and understanding these trends could be the key to your financial success. See you in the next episode of Boni's Life.